Today, the Fed demands further substantial progress. Hello again, it's Martin North from Digital Finance Analytics, welcome to this post covering finance and property news with a distinctively Australian flavour. Overnight, we got the latest from Fed Chair Jerome Powell via a press conference and release following the latest meeting. In essence, they are not planning to follow Canada's throttling back of bond purchases, so QE continues at the rate of $120 billion a month, and there was no change in the target rate. Federal Reserve Chair Jerome Powell and his colleagues upgraded their assessment of the US economy, but said that they were not yet ready to consider scaling back pandemic support. Amid progress on vaccinations and strong policy support, indicators of economic activity and employment have strengthened, the Federal Open Market Committee said in a statement, after holding its key interest rate near zero and maintaining the $120 billion monthly pace of asset purchases.
Today, my colleagues on the FOMC and I kept interest rates near zero and maintained our sizable asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. Widespread vaccinations, along with unprecedented fiscal policy actions, are also providing strong support to the recovery. Since the beginning of the year, indicators of economic activity and employment have strengthened. Household spending on goods has risen robustly. The housing sector has more than fully recovered from the downturn, while business investment and manufacturing production have also increased. Spending on services has also picked up, including at restaurants and bars. More generally, the sectors of the economy most adversely affected by the pandemic remain weak, but have shown improvement. While the recovery has progressed more quickly than generally expected, it remains uneven and far from complete. The path of the economy continues to depend significantly on the course of the virus and the measures undertaken to control its spread.
Marking a clear improvement since COVID-19 took hold more than a year ago, the Fed said risks to the economic outlook remain. That softened previous language that referred to the virus posing considerable risks. And the statement also noted that sectors hit hardest by COVID-19 had shown some improvement. And on the risk of prices rising, policymakers said inflation has risen, but largely reflecting transitory factors.
The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been the hardest hit. In particular, the high level of joblessness has been especially severe for lower-wage workers in the service sector and for African Americans and Hispanics. The economic dislocation has upended many lives and created great uncertainty about the future. Readings on inflation have increased and are likely to rise somewhat further before moderating. In the near term, 12-month measures of PCE inflation are expected to move above 2%, as the very low readings from early in the pandemic fall out of the calculation, and past increases in oil prices pass through to consumer energy prices. Beyond these effects, we are also likely to see upward pressure on prices from the rebound in spending as the economy continues to reopen, particularly if supply bottlenecks limit how quickly production can respond in the near term. However, these one-time increases in prices are likely to have only transitory effects on inflation.
The yield on the 10-year Treasury has retreated to be slightly lower on the day as Powell spoke to reporters after briefly touching a fresh session high when the decision was announced. The dollar index slipped to a 2-month low. The pricing of Fed policy tightening in the coming years was pared slightly, while the S&P 500 index reversed an earlier gain to trade little changed. Powell and his colleagues met amid growing optimism for the US recovery, helped by widening vaccinations and aggressive monetary and fiscal support. President Joe Biden will unveil a sweeping $1.8 trillion plan to expand educational opportunities and childcare when he addresses a joint session of Congress later on Wednesday, while highlighting his $2.25 trillion infrastructure proposal and the $1.9 trillion pandemic relief package that he signed into law last month. At the same time, a rise in coronavirus cases in some regions around the world does cast a shadow over global growth prospects, giving policymakers reason to remain patient on withdrawing support. Fed officials have also been largely dismissive of inflation risks for the time being, saying a jump in consumer prices last month was distorted by a pandemic-related decline in prices in March 2020. And by the way, Wednesday's FOMC decision was unanimous. Powell told a post-meeting press conference that the recovery has been faster than expected, but it remains uneven and far from complete, and the economy is a long way from our goals. US central bankers repeated they would not change the pace of bond buying until substantial further progress is made on their employment and inflation goals, and the target range for the benchmark federal funds rate was kept at 0 to 0.25, which is where it's been since March 2020. Powell said that it was not yet time to discuss scaling back asset purchases, and it will take some time before we see substantial further progress. Now, forecasters expect the US economy this year to expand at the fastest pace in more than 3 decades, with the Fed expected to announce in late 2021 that it will start slowing the pace of asset purchases. US central bankers have backed expansive fiscal policy, noting that millions of Americans are still unemployed and run the risk of remaining jobless for a long time if they don't find work soon. And since their meeting, officials have seen the S&P 500 stock index continue to rally, while yields on the government 10-year note, after a sharp move up in the first quarter, have traded in a range around 1.6%, and the labour market in March added the most jobs in 7 months, as improvements across most industries boosted non-farm payrolls by 916,000. And officials have also said policy changes will be based on outcomes, not a forecast, meaning a string of powerful monthly labour market gains will be needed to merit substantial further progress. And by the end of Wednesday, the S&P 500 had slipped into the red after hitting intraday highs, and the S&P 500 closed 0.05% lower after hitting that high of 4,201.85. The Dow fell 0.48%, and the Nasdaq Composite was down 0.3%. The unchanged central bank decisions did pressurise bond yields, helping techs cut some of their losses following mixed corporate earnings. Alphabet reported first quarter results that topped analyst expectations, and they announced a $50 billion share buyback, sending its shares 3% higher. Microsoft ended down nearly 3%, even as the tech giant reported better than expected results, underpinned by strength in its cloud business. The results were received on Wall Street, with several analysts lifting their price targets on the stock. Chip stocks fell 1% as AMD gave up its intraday gains despite posting blowout first quarter results. And Spotify technology slumped about 11%, despite reporting quarterly results above consensus estimates and guiding for a smaller than expected loss for the second quarter. Energy stocks, meanwhile, were boosted by a rise in oil prices after data showing a smaller than expected build in weekly US crude inventories cooled investor worries that rising global infections would soften demand. And Boeing was down nearly 3% as a drag on the Dow, as the aircraft maker's narrower than expected loss didn't offset concerns that aviation demand will continue to be challenged as the pandemic impact continues. And of course, then later today we're going to hear President Biden on his $1.8 trillion American Families Plan. Biden plans to fund the package, which will include funding for additional expenditures on childcare and education by nearly doubling the capital gains tax for Americans making over $1 million per year. So you can see that there's a lot in play there, but it's interesting that, again, all of the messaging is that inflation, if it appears, is transitory, nothing to see here, and it's still possible that a lot of the stimulus that people are talking about will not translate into higher inflation at all. So we'll see how this plays out. But today's outing really was a bit of a damp squib, insofar that nothing much has changed. And elsewhere, JPMorgan Chase is evidently preparing to offer an actively managed Bitcoin fund to certain clients. And that becomes the latest, largest, and if the CEO's well-documented distaste for Bitcoin is any indication, unlikeliest US megabank to embrace crypto as an asset class. The JPMorgan Bitcoin Fund could roll out as soon as this summer, according to sources who claim to know what's going on. Institutional Bitcoin shop NYDIG will serve as JPMorgan's custody provider, again, according to a source. JPMorgan's Bitcoin Fund will be actively managed, and that's a notable break from the passive fare offered by crypto industry stalwarts like Pantera Capital and Galaxy Digital, which let well-heeled clients buy and hold Bitcoin through funds without ever touching it themselves. Galaxy and NYDIG are now offering Bitcoin funds to Morgan Stanley clients. The JPMorgan Fund will evidently be for private wealth clients, and the move by JPMorgan marks a sharp turn for the $3 trillion bank. JPMorgan CEO Jamie Dimon called Bitcoin a dangerous fraud in 2017, threatening then to fire in a second any trader who touched the stuff. If you're stupid enough to buy it, you'll pay with the price for it one day, he said at the time. And while he quickly walked back the fraud label and was more recently toning down his rhetoric, Dimon, who has repeatedly argued that government regulation of cryptocurrencies is inevitable, maintained late last year that Bitcoin is not my cup of tea. Despite its CEO's personal disdain for the crypto, top deputies within its corporate and investment bank division acknowledged in February that client demand might force the institution to change. JPMorgan's hulking investment, commercial banking, and wealth management divisions have gradually evolved in their treatment of crypto and blockchain, even if the client-facing Bitcoin fund is new. And the bank's research analysts regularly issue market insights on Bitcoin's price and prospects in reports available to clients. The firm's Onyx division seeks to speed up interbank payments via blockchain technology and JPM Coin, for example. After 5 years of quiet development, Onyx is mounting a global hiring campaign for blockchain engineers. And on the investment banking side, JPMorgan issued its first crypto-adjacent investment product in March, a structured note tied to the performance of Bitcoin proxy stocks such as MicroStrategy and Riot Blockchain. JPMorgan's new fund product, however, will be its first directly dependent on Bitcoin's performance. So once again, a potential further reason why Bitcoin's price, perhaps, will be on the rise. And in crypto land, Ethereum was up 4.36% to 2,735, while Bitcoin was down 0.33% to 54,746, having recovered a little from recent lows. The S&P 500 futures was up 0.24% to 4,186, and the Nasdaq futures was up 0.49% to 13,960. And the Aussie US dollar was up 0.16% to 78.01. And the ASX futures was up 0.52% to 7,058 before the opening. So all of this leaves me with the question of whether that old adage, sell in May and go away, makes some sense. The indices seem to be bouncing along the top. The stimulus packages continue, and the Fed isn't changing direction anytime soon. Makes you wonder, maybe now is not a bad time to take some profits. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.